they've definitely stayed quite balanced on this. They're showing some patience with wanting to see how things do eventuate. Kia ora, and welcome to a special reactionary episode of the New Zealand Property Market Podcast, brought to you by Cotality on the 18th of February 2026. I'm Head of Research Nick Goodall, and I'm joined as per usual by Chief Economist Kelvin Davidson. Kelvin, certainly no surprise with the official cash rate on hold at 2.25%, but of course it was the first statement for the Reserve Bank underneath the watchship of Anna Bremen, the new governor. What did you learn, mate?
Well, yeah, but for everyone is the way I'm sort of summing this up. I mean, a lot of things were obviously the OCR itself was left unchanged, but a lot of the economic forecasts were sort of as anticipated as well. They've got economic growth coming back, GDP rising about 3% this year, kind of pretty standard forecast. Employment growth coming through, the unemployment rate edging lower. They've got that going down to about 5% by the end of the year. So that's sort of the vibe is similar to last time. They said probably think that CPI inflation is back within the target already in the current quarter. So, a temporary kind of rise above 3% tail end of last year, back probably within target right now. So, yeah, lots of things as you'd expect. They talked about spare capacity being a key factor there, bringing down inflation again, and sort of fits really strongly with the guidance they gave in the last statement. And statements like the quotes from the release, things like if the economy evolves as expected, they'll keep monetary policy accommodative for some time. So sort of hints at no rush to shift. However, one thing that did change just ever so slightly was the official cash rate track itself. So now looks pretty likely that they plan to, rather than the first increase coming in early next year, early 2027, they now plan to push that through into late 2026. Now, the timing's a little bit hard to pin down because of the way they express the numbers. I guess they give themselves a wee bit of wriggle room, but it looks like tail end of this year, I should say. So, yeah, I mean, there's nothing necessarily surprising there either because it's what markets are anticipating. It's kind of what we know. If the economy does start to pick up, we'll probably see a bit more inflationary pressure, and you'd want to take away some of that monetary stimulus that we've got now. So they use the phrase settings will gradually normalise. So implies a steady return to sort of about that 3% mark over a series of months. So yeah, I guess a bit for everyone, as I say. I mean, if you were in the camp that says, okay, no rush to tighten, well, you've definitely got that because they're not suggesting any rush to tighten. But also, if you were saying, okay, well, I think they'll start tightening this year, well, that's in there as well. So yeah, I'd call it as expected. Pretty steady, nothing sort of shocking in there. The language seemed the same. So, yeah, I guess we'll kind of, digest it and move on.
Yeah, I think it's an interesting one. But the words I think of are, balanced, as you say, but if for everyone would have been wondering how they're going to react to the last few months of data. And we've talked about in the last few weeks that every time a new data release comes out, there's two ways to read it all the time, whether it's the disappointing unemployment figures, which you can read in two ways once you get below the details. The CPI, of course, going above band, but like you said, expectation of that still to drop down. And when everyone talks about core inflation in terms of that medium-term inflation as well, there's nothing to panic there. So, yeah, I think you could read all those things sort of two ways. They've definitely stayed quite balanced on this. They're showing some patience with wanting to see how things do eventuate. I think it's an interesting time, right? Like, really hard to compare November to February. A lot happens in that time, but you don't necessarily get enough data over that genuine period of time either through to understand what's actually happened in December, January, halfway through February. How has this, economy come back? How have people come back to the new year with their expectations on this economy, on their jobs and everything else too? So it does feel like, there's a lot of patience in there as well. I like you said, I think that's a good point that they, continue to talk about the fact there's spare capacity in the economy and that's why they're happy to keep it sort of the accelerator on the economy, I suppose, if you think about that with the OCR remaining below that neutral position of around about 3%. So, yeah, I think it's a pretty good summary, mate. I mean, maybe worth noting, the vote, of course, was unanimous. No surprises there to hold it. Everyone expected that. I recorded our monthly video in advance of the decision and was confident enough to put on video that the OCR was held before it was even decided. So would have been in trouble if something changed. I would have had to go back and record that. But yeah, that's I think just shows how clear it was that we weren't going to see any fall, and there was no way they were going to lift it this early either. I think as well, like we say, with that forecast of the official cash rate and when that lift will be, yeah, certainly reaffirming it's likely to be later this year than maybe what they said 3 months ago. But I do think it was a firm, pushback to market where some analysts had brought their forecast that, it might be as early as September that we see an increase to the OCR. This shows that they don't really expect that to happen. They want to push back on that market expectation. So I think that's been an important insight from this one as well. Yeah, I don't know if I've got too much else there. I don't know if you touched on the house price growth there, that they did actually have some numbers in there showing, yeah, they expected a bit more weakness to come through in the first 3 or 6 months this year, including some declining prices, which would continue what we saw in the first month of this year, albeit very gradually. That might be a little bit pessimistic in my mind, but hard to argue with that. But a bit of growth coming back in the second half of the year, and I think that's what we keep talking about, right? Is that we're going to likely see some growth. There's reason to think there's some value growth to come through for the property market, but with every month, with every bit of data, we sort of tend to push that expectation a bit further down the track, a bit further down the year. So again, it probably lines up with what we've been talking about, albeit we haven't had an official forecast there. And the other thing, as I've been doing, is the uncertain watch. The number of times the word uncertain or uncertainty pops up, and it has dropped once again. I had it 32 in November, down at 25 now. So again, I suppose that's got to be a good thing to market. The certainty's removing. That's despite lots of things going on globally, which do mean we're not sure exactly, which way things might go, whether it's inflation, labour market, the economy. There's still a bit of uncertainty about that, but it's certainly improved on where it was a few years ago. I think, or even last year in May, there was sort of 80 references to all the uncertainty out there globally. So I think that certainty is also helping with that confidence and where things are going. Yes, there's some concern with some inflation, being a bit higher than we expected. The selected price indices this week showed that, food was continuing to be at the higher end, and we don't want that. But overall, they seem pretty comfortable with those core inflation measures. It is tracking downwards, and that allows them to be comfortable to be in that, what do they call it, accommodative settings for the official cash rate, to encourage a bit more borrowing and get that lending going on, which in their mind will hopefully boost the economy off the back of that as well. So yeah, look, I think that's pretty much all from my notes. Anything else jump to mind as I was rambling on there, mate?
I'll just, I guess, what might happen to mortgage rates. I mean, the banks have probably been reacting ahead of this anyway, so I think it probably just kind of backs up what they had expected to happen. So, not necessarily a reaction in mortgage rates. I don't suppose they've already lifted a little bit across some of those terms recently, and I think that just probably is what they've done today with that change in the OCR track, just sort of backs up what's already happened from actual mortgage rates. So yeah, that's part of it. And we've already touched on the house price outlook. I guess there's still a sort of balance out there with, sort of some financing benefits to come through as people roll off higher mortgage rates, but still a cautious attitude at the same time. And maybe the labour market doesn't really turn around sharply for 3 to 6 months yet. That keeps a bit of a lid on things. So, and then you've also got things like DTIs. You've got a rise in the stock of housing versus our population lately. So yeah, it's hard to disagree with that Reserve Bank outlook that the housing market does remain pretty muted. You could quibble about the exact numbers, but the overall tone is that we're not going to see a lot of house price growth really for this year, and maybe even into next year. So yeah, it's hard to disagree with that. So yeah, pretty cautious sort of statement all around, I guess.
Yeah, slightly more damper on the house prices than we expected or had thought previously. And good point on the interest rates too. Like you said, most of the movements have been made in advance. Maybe this means there's less likelihood of those little gradual increases in the 6 and 12s over the next couple of months until we hear and see a bit more. On that note, in terms of big releases coming out, I've got Q4 GDP data still a month away, 19th of March, so we won't really get a feel for that's Q4. Earlier in the week, obviously, we talked about where the NZAC came in and our expectations for GDP. I've seen some economists pull back their expectation for Q4. We had, I think, 0.6% we were talking about. Maybe it's a little lower than that for Q4, but yeah, we really want to know what's happening in this quarter, and some of those faster moving measures are showing us that it's not quite as good as maybe we saw in the last half of last year. The next Reserve Bank decision for the official cash rate, of course, just a review, not the full statement, on the 8th of April, around about 6 weeks away. We don't get Q1 CPI inflation data until the 21st of April, so that will be after their next decision. Labour market data on the 6th of May for Q1, and then we've got the monetary policy statement in full with all the forecasts and everything on the 27th of May. So they will have the CPI inflation and the labour market data, not the GDP data for Q1, but they will have Q4 data and that nowcast GDP from their own model as well. So, that 27th of May probably shapes up as a pretty crucial one when we have, a bit of data from 2026 itself. So, a few key dates to put in the diary and watch out for. But otherwise, that's probably us for the day. Kelvin, any final words before I close us out?
No, that's it. As I say, but for everyone. So if you're depending on which camp you're in, you could probably find something for you in this statement. So pretty balanced.
Which is like all the data in the last couple of months. So fair play. Balanced, patient, but for everyone. Like it. That'll be one of those will give us the title for today, I suspect. So great stuff. And thanks for digesting so quickly so we could get recording, and we'll get that out and about to everyone very soon. So just leaves me to say thanks for listening. Please do make sure you subscribe to the show and feel free to get in touch. My name is Nick. He's Kelvin. You've been listening to the New Zealand Property Market Podcast. Mā te wā.